Imagine for a moment that the market drops 40% overnight. Your portfolio, the savings you spent years quietly building, cut nearly in half before your morning coffee. Now ask yourself honestly, what do you do? Do you sell everything, paralyzed by the fear that it will keep falling? Do you hold steady, telling yourself that markets recover even when every headline says otherwise? Or do you buy more, seeing opportunities where others see catastrophe? The answer you just gave in your head is that instinctive, emotional, gut-level answer that is your real risk tolerance. Not the number some algorithm assigned you after a 10-question quiz. Not the box you checked on a brokerage form. The actual answer. And here is what most financial education never tells you. The distance between who you think you are as an investor and who you actually become under pressure is where most wealth is quietly destroyed. Today, we are going to close that distance without a single complicated test. Risk tolerance is not a fixed number, and it is not something you can accurately self-report while sitting comfortably at your desk on a Tuesday afternoon. Behavioral economists at institutions including the University of Chicago and the London School of Economics have documented extensively, and the research is consistent across decades and cultures, that people systematically overestimate their own comfort with risk when markets are calm and systematically underestimate it when markets are falling. Daniel Kahneman's foundational work on loss aversion established that the psychological pain of losing $1 feels approximately 2 to 2.5 times more intense than the pleasure of gaining that same dollar. This asymmetry is not a flaw in your character. It is a feature of human cognition that evolved over hundreds of thousands of years, a survival mechanism that happens to be extraordinarily counterproductive in financial markets where patience is literally rewarded with compounding returns over time. Risk tolerance exists across three distinct dimensions that most people collapse into one. The first is your risk capacity, how much financial volatility you can actually sustain mathematically based on your income, debt obligations, time horizon, and savings rate. The second is your risk perception, how volatile you believe an asset to be, which research consistently shows is distorted by recency bias and media exposure. And the third is your risk composure, how you actually behave when the market is down 30% and your friends are calling you to tell you they sold everything. Most standard risk questionnaires measure only your stated preferences, none of these three real dimensions. A 2023 study from Vanguard's behavioral finance research team found that investors who received personalized behavioral coaching during periods of high market volatility outperformed self-directed investors by an average of 3 percentage points annually, not because they had better stock picks, but because they made fewer emotionally driven decisions. 3% annually, compounded over 20 years, is the difference between retiring comfortably and retiring 5 to 8 years later than you planned. That is the system working against you quietly, invisibly, across decades. Here is where it gets genuinely interesting and where most financial content stops short. The psychological architecture underneath your financial behavior is not random. It is shaped by at least four distinct forces that operate almost entirely beneath conscious awareness. The first is your formative financial experience, the economic conditions present during your late teens and early 20s, which research by economists Ulrike Malmendier and Stefan Nagel, published in the Quarterly Journal of Economics, demonstrates have measurable, lasting impacts on your lifetime investment behavior. People who entered early adulthood during periods of high market volatility think those who turned 18 during the 2008 financial crisis or the 2001 dot-com collapse tend to allocate significantly less to equities throughout their entire investing lives compared to those who came of age during calm or bull markets. This is not a choice, it is a psychological imprint. The second force is your reference point, the price you paid for an asset versus its current value. Prospect theory, one of Kahneman and Tversky's most powerful frameworks, demonstrates that your emotional relationship to a stock is anchored not to its objective current value, but to the specific price at which you purchased it. This explains why investors hold losing positions far longer than rational models predict and sell winning positions far too early, capturing only a fraction of available gains. The third force is your social comparison threshold, the invisible benchmark you measure your financial progress against, which shifts dynamically based on the people around you, the media you consume, and even the neighborhood where you live. A 2019 study in the Journal of Financial Economics found that households living in higher wealth zip codes took on measurably more investment risk, not because their financial situation had changed, but because their reference class had changed. And the fourth, and perhaps most powerful force, is your narrative, the internal story you tell yourself about money, wealth, risk, and what you deserve. Elite investors, including Howard Marks of Oaktree Capital and Ray Dalio of Bridgewater, have written extensively about the importance of accurate self-assessment, and both specifically emphasize understanding your own psychological reactions to loss as a prerequisite for building any sustainable investment strategy. Understanding these four forces is not about becoming a different person. It is about understanding which version of yourself will show up when the market falls so you can build a strategy that works for that person, not for some idealized rational agent who doesn't actually exist. If you've watched this far, it means you're serious about your financial future, and that already puts you ahead of most people. Take a second to like this video, drop a comment below telling me your biggest financial fear, and subscribe if you haven't already, because we go this deep every single week. Your future self will thank you for the information you're gathering right now. Now let's put real numbers to this, because psychology without mathematics is just philosophy, and what we're building here is a usable system. There is a framework used by institutional portfolio managers at endowments, sovereign wealth funds, and family offices that translates psychological risk tolerance into actionable portfolio architecture without requiring a single questionnaire. It operates across three inputs that you can calculate yourself in about 20 minutes. The first input is your maximum drawdown threshold, the specific percentage decline you can observe in your portfolio without changing your behavior, not the decline you say you can handle. The decline at which, based on your actual financial history, you have made impulsive decisions. If you sold any investment between 2020 and 2022, you have data. Use it. Research from Morningstar's 2024 Mind the Gap report shows that the average investor underperforms the funds they own by approximately 1.7 percentage points annually due to mistimed entries and exits, meaning the average investor earns measurably less than the investments they choose purely because of behavioral timing errors. The second input is your liquidity buffer ratio, the number of months of essential expenses held in cash or cash equivalents outside of your investment portfolio. A 2023 Federal Reserve survey of consumer finances found that 37% of American adults could not cover a $400 emergency without borrowing. Investors without an adequate liquidity buffer are statistically far more likely to be forced sellers during downturns, not by choice, but by necessity, which is the single most reliable way to permanently impair long-term returns. The general institutional standard for this buffer is 6 to 12 months for employed individuals and 12 to 24 months for those with variable income. The third input is your time confidence interval, not just how many years until you need the money, but the probability-weighted range of scenarios in which you might need it earlier, because the market does not care about your retirement date, a sudden health event, a job transition, a family obligation. Any of these can transform a long-term investor into a forced short-term seller overnight. When you combine these three inputs into what institutional practitioners call a risk-adjusted behavior profile, your RABP, you get something far more honest and actionable than any quiz, a portfolio architecture that your real psychological self can actually sustain across a full market cycle, which historically runs approximately 8 to 12 years from peak to peak. The arithmetic here matters. An investor with a genuine 60% equity, 40% fixed income allocation who holds through a 30% drawdown ends up at 42% equity, 58% fixed income purely through market mechanics, which means their allocation has automatically drifted toward defensiveness at the worst possible time, right before the recovery begins. Understanding this mathematical reality in advance rather than discovering it emotionally mid-crisis is what separates the disciplined investor from the reactive one. Here is the systemic reality that elite investors understand but almost never discuss publicly. Risk tolerance is not just a personal psychological trait, it is also a function of the macroeconomic system you are operating inside of. And that system changes. Between 2009 and 2021, the Federal Reserve and major global central banks maintained interest rates near zero, which had a specific and measurable effect on investor risk tolerance at a population level. It pushed capital into equities and high-risk assets because the alternative, holding cash or bonds, generated almost no return. This created a generation of investors who built their entire risk framework during a period of artificial monetary policy conditions that were, by historical standards, extraordinary. When the Federal Reserve began raising rates in March 2022, beginning the most aggressive monetary tightening cycle in 4 decades, the risk tolerance of millions of investors was revealed not through questionnaires, but through behavior. Flows into bond funds hit record highs. Crypto collapsed over 70%. Growth equities shed decades of accumulated gains in months. And the investors who held through that volatility, who had built their portfolio architecture around their real psychological profile rather than their optimistic self-assessment, those investors entered the subsequent recovery in a fundamentally stronger position. As of March 2026, global equity markets have experienced 2 distinct high volatility regimes in 5 years. The macroeconomic backdrop elevated debt levels across major economies, geopolitical fragmentation, AI-driven sector disruption, and ongoing central bank normalization continues to create conditions in which investor behavior, not asset selection, is likely to be the primary determinant of long-term returns for most retail participants. The identity shift that all of this points to is this. Stop thinking of yourself as an investor who is trying to find the right assets and start thinking of yourself as an investor who is building the right relationship with uncertainty, because uncertainty is the only constant in financial markets. Warren Buffett famously observed that investing is simple, but not easy. The simplicity is in the math. The difficulty is in psychology. And the investors who close that gap, who understand their real risk tolerance and build systems around it rather than fighting their own nature, are the investors who quietly, consistently, over long periods of time, build the kind of financial security that transforms not just their own lives, but the lives of people around them. So, let's bring it all together. Risk tolerance is not a score. It is not a questionnaire result. It is the intersection of your financial capacity, your psychological wiring, your formative economic experiences, and the macroeconomic system you are operating inside of, and it changes over time as all of those inputs change. The framework we walked through today, your maximum drawdown threshold, your liquidity buffer ratio, and your time horizon confidence interval gives you a real, usable starting point that no 10-question quiz can replicate. The goal has never been to eliminate risk. Risk is the price of return. The goal is to understand your real relationship with uncertainty well enough to build a portfolio that your future self can actually maintain without panic, without impulsive decisions, and without quietly destroying years of compounding in a single emotional afternoon. If this kind of deep, calm, data-driven financial thinking resonates with you, you are in exactly the right place. Every week on this channel, we go this deep into the systems, the psychology, and the hidden mechanics that shape financial outcomes without hype, without shortcuts, and without oversimplification. Like this video if it gave you something real to think about. Subscribe and turn on the notification bell so you never miss a week of this. and leave a comment telling me what was the most important insight from today. Was it the three-dimension framework, the behavioral math, or the identity shift at the end? This is not financial advice. This is education. And education, consistently applied over time, is one of the most powerful tools available to anyone who is serious about building lasting financial security.